Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Taking a look at this week's deal tracker for mergers and acquisitions, investments, and all of that from Viridian Capital Advisors shows that there's 5 fewer transactions, but a $0.4 million higher volume this week than the prior week. And compared to last year, the equal number of transactions closed with 164 million in higher volume. Average deal size around 48.2 million. 3 equity issues were raised for a total proceeds of 43 million, which was led mostly by Philo. They had a Series C round for 32.1 million. The only debt issue closed last week for 150 million. The issue was by AYR. Kind of interesting because it was the first yield to call original issue in cannabis. Viridian Capital Advisors, they expect that capital raisers are going to continue to tilt towards debt issuance, and they recommend that companies with a positive cash flow to take advantage of those solid liquidity and attractive terms offered in the debt market, and definitely urge companies that are willing to trade off slightly higher coupons for better repayment terms. And then total capital raised year to date in 2021 is 11.3 billion, approximately 1.5 billion lower than it was in 2018. That was the previous peak, but U.S. capital raises are far more robust. U.S. equity raises, they're up 109%. U.S. debt raises, they're up 7,735% compared to 2018. No one back then wanted debt. No one thought that some of these companies would be around, so they wanted an equity position for higher returns, even though property, plant, and equipment in the real world is more advantageous. That's going to be a more risk averse, so you want to hold on to everything. So interesting that even more companies are even aware of that. It just kind of surprises me. It's obvious for some MSOs, publicly traded companies, but a lot of these others in the US, they're so bogged down with their state and regulatory compliance that they don't really know some of these financial options. So I find it kind of interesting. But when you look at Canada raises, they're off a little bit. Those equity raises are down 75%. Debt raises are down 15%. I think because you're seeing all these other debt raises at 7,735% in the US because of the speculation. Looking at capital raises, breaking that down by sector, you can see that capital raises came in from a diverse list. So agriculture and technology, they had 1 equity. Cultivation and retail, they had 1 debt raise. Software and media, they had 2 equity raises. So kind of all over the place. We saw some cannabis stocks that were up 14% last week on the related news of the Republican-led bill. They've retraced another 5.5+%. Year to date, cannabis stocks are down 12%. S&P is up 24%. So even our own cannabis portfolio at the C3 fund, we've hedged that with other ESG and SRI companies because cannabis stocks are just so bad. It'll just sit there all in cash, for quarters upon quarters. It used to be just an entire month. It'd sit there in cash. You're like, well, what's the deal? And so finally, we just kind of added some more equities to that portfolio because cannabis stocks are momos, they're momentums. They move with the news, and that's about it. So trying to diversify, make that portfolio a little bit more interesting year round. Last week, there was also a big week for third quarter earnings release. Had little impact on the stocks, though, because nothing other than federal legalization seems to move that. But looking at results for some top MSOs, looking at mostly negative EBITDA. So there wasn't a whole lot of gain after the announcement, probably because of all of the misses. There's an EBITDA miss, huge percentage, like 45% missed on that. And then revenue up, 15% missed on revenue. So a little bit hyperbolic on the earnings expectations. And so, yeah, nothing really happens after those gains. People don't really want to sell off, I guess, and take their loss. They're just holding on. Looking at some of the big gainers and losers for mid-November. Just on the week, Sundial had a 43% weekly increase, and year to date, 35%. So they came into the year at in the red. Jushi, same thing. Wow, they were up 43%. They're still down negative 38%. Consortium, they're still down there in negative territory as well. So we mentioned that the largest equity raise on November 8th was Philo, private cannabis compliance platform, announcing a $32 million Series C, proceeds to build the company's talent base and make accretive acquisitions. Basically a blank check company or a SPAC, same thing. Eminence Capital led the round with Longview Capital and some other firms. Software media sector raised 1.1 billion year to date, more than 4 times the previous year's totals. And this sector is the target of a rapidly increasing number of M&A transactions. For obvious reasons, media, you have a lot of exposure. If there's influencers or reach, people are looking for that kind of exposure. And then software, obviously, if you have software as a service, that's great because you might have a lot of good data. If there's an app or things like that, then you're going to have, as an example, you're going to have a lot of information based on your clients that way. Some are tied into retail shops. Regardless, the data, the exposure, the accessibility to all of these individual potential customers is why they're throwing at least $1.1 billion year to date at media and software. Public company listings, 6 of the 9 companies that raised capital were public, 5 in Canada, 6 were in the US, with equity versus debt raises, seeing equity accounting for 5 of the 9 raises and just 30% of the capital. So more money is coming from the debt side, but more transactions on the equity side. I find that interesting that people are getting more on the equity. Maybe that's just a pivot point for investors. Maybe the FOMO investors are coming in, grabbing some of these non-accretive equity deals, whereas the more savvy investors are looking at some of the debt rounds. I'm not really sure. But as we mentioned, the only debt transaction, the $150 million, was AYR issued, believing that the kind of optimism of federal legalization could have an effect on the cannabis equity issuance. So some companies don't want to raise equity if they think there's a chance for legalization. So they're going to throw the debt out there. And they think that there's debt issuance is going to be strong for a couple of reasons. That one, the top US MSOs are firmly EBITDA positive and continue to be under levered. They've got large publicly traded, well-funded debt investors that are in a race to build a high coupon book before the radical tightening of spreads likely to follow legalization. They'll get in now while you've got investors that don't want to get into the game because of sin clauses or that sin stock, the shunned stock hypothesis, where people just don't want it until it's so sexy they can't resist it. We mentioned the debt round, $150 million for AYR. Yield to maturity, the reason why that looks so good is because the debt is incredibly cheap. So yield to maturity, 9.8%. Seems high relative to the company's credit quality. But like if you look at it though, their 4th best credit, but 9.8% yield to maturity is the highest of any company on the chart. So it's showing that YIR should have received a rate below 9, particularly given the downward drift in debt costs. But for whatever reason they took it, it's still better than it used to be, and probably kind of took the first deal that they were offered. But if we ask, why did they open their existing indenture rather than selling a new lower coupon issue? You can see the 12.5% senior secured note is callable at 106% beginning in December of 2022 and par beginning in 2023. What does this mean? AYR basically avoids incremental debt issuance costs that would come from selling a new issue, which basically boils down to cannabis investors should become focused on those types of calculations, given the likelihood that some form of legalization is going to happen. Looking at mergers and acquisitions, there's 5 closed M&A transactions compared to none in the prior year period. Looking at the fact that public companies were the buyers in 85% of those transactions. So there's 19 US targeted M&A transactions with 8.5 billion in total consideration. So both transactions and the consideration exceeds the values reported in each of the last 2 full years. So we're starting to see this driver of acceleration in the US with mergers and acquisitions, continuing that valuation gap discussed over and over again. Cultivation and retail companies have large market caps. Some are trading at over $1 billion market cap with very good EBITDA multiples. So in contrast, there's some companies with less than $1 billion that are trading at half that market cap. So there's an arbitrage opportunity for almost every single MSO to make an acquisition, have that becoming immediately accretive on an EBITDA per share basis. So stocks of all of these MSOs are down, but their targets are down even more. So those acquisitions still look good. So I kind of said, as soon as 2-3 years ago, I said on the podcast, as soon as there's a market correction, watch for a massive amount of consolidation and then capitulation as people just give up for that very reason. One of the more interesting M&A deals, that was Verano Holdings, fourth largest MSO by market cap, bought Willowbrook Wellness, an owner of a dispensary in Connecticut, $131 million in total consideration. Of the 5 acquisitions that were made, all of them were public company, or 4 of the 5 acquisitions were by public companies. In terms of M&A by sector, most of the acquirers were cultivation and retail, and then most of the target companies were also cultivation and retail. So cultivation and retail sector companies were the targets of about 60% of all cannabis M&A transactions in the second half of 2021, representing a historic high, mostly because people didn't want to touch the plant, the flower before that. Now they know that federal legalization is imminent, and they're going to give carte blanche to anybody who has an existing license. So vertical integration is the way to go, even though the plant is getting commoditized and it's a race to the bottom in terms of price pressure. They know that that's imperative for the time being in order to have that tool in their toolbox. It's just seed to sale. They want to control the entire the entire supply chain in order to have control, not only pricing, but when they know when it's going to be harvested and sold, as well as control of quality, all of those factors. The US looks hotter and hotter as Canada kind of starts to fizzle out with their excessive valuations, and knowing that there was a lot of bloat. You can't write off billions of dollars and expect investors to kind of keep coming at you. So I would think that as Germany just announced that they're going to legalize, they're going to be the 3rd country in the world to do that. It's going to be a domino effect after that, creating a lot of FOMO. So I anticipate there would be a lot more mergers, a lot more excitement, a lot more acquisitions, a lot more investment, a lot more podcasts. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.